highlighted, well, officially recorded remittances flows to low and middle income countries are expected to rise, increase about 4.2% this year to reach $630 billion. The projection is an increase from a previous $565 billion announced in the first quarter of this year, as education and health remain leading users and purposes of sending money back home to low and middle income countries. Nigeria received about 270 million pounds via world remittance of June the 1st, 2022. Other top receivers were Zimbabwe, Ghana, Uganda, Tanzania, South Africa, and Somaliland. This follows an almost record recovery of 8.6% in 2021, according to the World Bank's latest migration and development brief, with Kenya being among the biggest recipients in Africa. And to our next conversation now. Last year, startups in Nigeria reported to have attracted over $150 billion, which was 35% of the total investments that came into Africa in 2021. Let's get a sense of VC funding in 2022. We have Oji Udezwe, principal at Product Mind, join us right here on Business Incorporated. Great to have you.
Hi, how are you doing?
I'm good. So how are VCs warming up to startups in 2022, you know, with the economic headwinds we're seeing right now with inflation and rising borrowing costs?
Yeah, so it's been a very interesting year, as you can imagine. You know, market contraction, inflation, and, you know, the asset markets have been inflated for some time, even before commodities. And so a few things are happening in the VC world. First of all, VCs are backing away from general frothiness of deals done through groupthink, things where there's not enough due diligence. I think earlier stage deals are going to suffer. Things that are just, there's no traction and they're interesting concepts and problems to solve. And valuations are shrinking as well, which is connected to the first thing I said about asset price inflation. It's been a bit nuts over the last 3 years. But VCs aren't going away. They're not investing in Nigeria or Africa in general. They're still spending resources, hydrating their brands, supporting existing investments, and keeping startups warm. Because what they don't want to do is that if there's a big and fast recovery, they don't want to be priced out of the market or not connected to the markets they're interested in. And they want to be able to be in a strong position to continue to invest in new deals when the market sort of recovers. So what entrepreneurs should expect is they should focus on traction, on growth and profitability. Hype will not sell as well as it did just a few months ago. You know, luckily, Nigerian entrepreneurs have always been a step ahead because it's always been difficult to raise money from our economy. Entrepreneurs might need to bootstrap a little longer. Remember, if you can do this while driving performance, you may also be able to keep your equity for longer instead of selling it to VCs.
Right, and what kind of questions are venture capitalists asking these startups right now?
So what you're seeing is essentially just a lot more due diligence. You know, the last few, you know, Kernel Fund, which I'm a principal of, has invested in the last 8 years. And in the last few years, we've seen deals that move so quickly that it's really, really hard to get into a lot of due diligence. Well, since the funding cycles are going to sort of lengthen, people will start to ask deeper questions. So some of the things that they'll look at founders to figure out if their prior experiences and insight into the market they're attacking are really strong. So you don't just go into a space that you know nothing about, or at least they have a very serious track record with previous company founding. They're scrutinizing founders for good skill matches to the problem they're trying to solve. So, you know, if you're a consulting or finance type versus you need engineers to build a company, that might be a big mismatch. They're asking hard questions about the market, about the buying power of your customers, about the ability to adopt what you're selling in a low expertise and low infrastructure market. And they're looking at real market size, not hype, which is related to the adoption and use of profiles. So what are people using, not what are people signing up for? And above all, they're looking for signs of traction. They're looking for signs of growth. They're noting the cost of customer acquisition. Obviously, lower is better, unless you're truly an enterprise company or targeting the enterprise space, and unit economics that can be scaled. So these are much more hard number, traction-driven venture capital investment is what you're seeing.
Yeah, so the startups need to do more, at this point. But, an investor might see, 500 million phone subscribers, but that doesn't mean all the phones are smartphones, and it doesn't mean that all those phone subscribers can afford enough data to power up, the app and, be always connected. So how do these investors figure out, the real size of the opportunity?
It's a little connected to what I said before, which is harder question. So the addressable market, which is what a lot of founders talk about, is a little pointless. You see these decks with, oh, Africa is this big, here's a growth trajectory, here the young people, blah, blah, blah. All those things are pointless. They don't really offer investable information. Smart VCs know this. So what is important is what part of the market is gettable. So things like how many subscribers to your service, not just signups. What is the activation rate? How many people are actually using it? What are the retention metrics? People keep coming back and rate. What does churn look like? Who leaves your funnel every single week? And by the way, are you set up to do anything about all this data? So if you see weakness in any of these things I've talked about, can you recover from it? Can you do things to close the gaps? Startups are increasingly customer data intensive platforms, so they can answer difficult questions for their investors and for themselves. So as VCs stop jumping on the bandwagon, they will insist that their next level questions be answered or they may not invest.
Quite interesting. So what do you see for the second half when it comes to raising funds for 2022?
There'll be probably fewer deals, but all those relationships will be maintained. People who are in danger of running out of money, the VCs will try to support them. I think it's really a chance for Nigerian entrepreneurs to go back to the basics, really, if they're in the tech sector, and to think about their burn rate, how long they will last if they get no new money. They have to think about all these things. You see companies in the West like Coinbase or even Facebook sort of freezing hiring so they can control their burn rate, even though they're very successful. So the same kinds of things need to happen in the startup community. So I predict fewer deals, not just in Nigeria, but all over the world. And we'll see how long this contraction happens, because that's going to probably be related to how long those sort of more famine conditions persist.
Right, and all eyes on the possibility of a recession, global recession at this point. We'll keep tracking all of that. Thank you so much, Orji Deswe, Principal at Product Mind. It was great having you on the program.
Thank you very much, sir.